Hi, everybody. My name's Steve Baums. I'm the Executive Director of the Financial Data and Technology Association of North America. It's a consortium of fintechs and data aggregators. And I am absolutely beyond excited to be hosting a panel on what to expect out of the regulatory world on fintech over the next several years. We have an all-star panel to discuss this issue. I will very briefly introduce them, although I think we could spend the entire 40 minutes talking about their qualifications. But before I do, just one logistical note. You see that you have the chat function on your screen. As we're having this conversation, please feel free to put any questions or comments in the chat function so that we can make sure that we come back and respond to them after we've had our discussion. So with that, I will very briefly introduce the panel before we get into it. First, we have Julapa Jagtiani, a senior economic advisor and economist at the Federal Reserve Bank of Philadelphia. We have Conan French, a senior advisor at digital finance at the Institute of International Finance, and Aaron Iveen, who's the head of policy and regulatory affairs at Cross River Bank. And Aaron, maybe I'll start with you, if you don't mind, because before we get into this conversation about what to expect over the next several years, I think it's important to talk about how we got here in the first place. And Cross River has obviously been at the front and center of fintech partnerships for many years. So can you tell us a little bit about, from the Cross River perspective, how it sees fintech growth over the last several years?
Absolutely, and thank you so much. It's a pleasure to be here today. So Cross River is definitely a unique entity, and starting really in the midst of the last financial crisis in 2008. And so at a time when banks and institutions were pulling back access to credit, weren't lending, were figuring out their balance sheets and the loans there, Cross River entered the space with a clean balance sheet and abundance of capital to deploy. And so lending was an opportunity from the beginning for Cross River. And so kind of organically, we were able to find partnerships within the fintech space. And so it started with point of sale lending at Home Depot, right, with a company called Green Sky that we were working with. And basically, whether you were trying to do a whole kitchen renovation or just purchasing a new sink, you do a point of sale loan, Cross River would be underwriting that loan, doing the due diligence and compliance behind it, and allowing our partners to focus what they were best at. And that really was the technology aspect, right? The innovation. We always like to say we're the regulatory gold standard. We're the bank behind these partnerships that really understands the compliance, the regulatory framework, the structures, the due diligence, everything that makes sure the consumers are being protected and being offered avenues to responsible and safe innovation. And so from there, it was the natural evolution continuing in the marketplace lending, online lending space, working with over a dozen partners now. And as the industry evolved and as technology evolved, so did Cross River. So we went from just being really supportive on the regulatory compliance and banking side to really growing in-house our own technology capabilities, our own innovation to keep up with our partners, to be able to offer them the best experience. And I think as we've seen over the last few years, lending might have been one of the first areas to really welcome fintechs and these new companies. But payments is another huge aspect of what's going on. How do we get consumers access to their cash quicker, safer, more efficient, so that they can avoid certain products that trap them in cycles of debt? So push to card capabilities, faster payments, real-time payments, all other areas of extension and expansion that fintech has played a huge role in when partnering with regulated financial institutions to really make a difference in the ecosystem and the lives of consumers.
So Aaron, it's perfect segue. So Jalapa, I wonder if I can then ask you, as we've seen the growth in the marketplace, regulators have used the tools that they have available to them over the last several years, from statutes that in some cases are decades old, to apply more supervision or governance over the fintech sector. And I'm thinking specifically about things like third-party risk management. I wonder if you can talk a little bit about, generally speaking, how regulators think about fintech regulation today.
Sure. First of all, because I'm with the Federal Reserve Bank of Philadelphia, so I wanted to remind everyone that everything I say today is my own view and not the views of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. And yeah, so Aaron did talk about all that the importance of fintech and the growth during the pandemic, where actually Cross River Bank was one of the largest PPP originator during the pandemic, and partly. Uh, well, a lot of small business lenders were not able to access the PPP funding because banks have had prioritized their existing customers, and so a lot of the customers that don't have the moms and pop shop actually rely on fintech. And beyond that, uh, we saw that within the like 4 or 5 weeks, the beginning of the lockdown, as Aaron said, payment, real-time payment, nobody goes walk to the bank branches anymore because it's all closed, and people are accepting digital signature, and so everything is done digital online. And if you don't do that, basically you are in trouble. So actually, digitization in banking was really booming in during the pandemic. In things that happened in 5 weeks, for example, actually could have taken 5 years to take place without the pandemic, without the lockdown. So yes, a lot of changes, and it happened very quickly. And so a lot of people come to expect that everything is done digitally, end-to-end process, digital account opening, for example. There are some like neobank, challenger banks that are doing really well, and there are some other banks that are not doing very well because they don't transform soon, fast enough. So in terms of what we think about in terms of regulators, we of course we need to adapt as well because it's a totally different environment, and and the tools that we need to use, of course, the bank examination, for example, we can't walk into the bank to do on-site exams anymore. Everything has to be done electronically, and a lot of fintech partnership because banks need to access technology, and the fastest way to do during the pandemic was through partnership with fintech vendors, and they use that to open new accounts. They use that to those that that partner with some other fintechs actually could also do end-to-end mortgage origination without any human touch. And this part, some also use it for credit decision, right? Using because FICO score doesn't have much meaning anymore because you can't rely on FICO score to grant loan or credit card just because it's just reflecting a missing payment during the pandemic. And so alternative data became very important, and so a lot of alternative data are being used, and ML models are being used through this black box that through the fintech vendors. So banks may not be understanding what they're doing, and so we need to also, from regulators' viewpoint, we need to look at that as well. So third-party vendor risk management is one thing, and financial stability, like putting things on the cloud or sharing space, API, direct API, multiple APIs also could open more weak spots where cyber can take place. A lot of different aspects that we need to take into consideration because of this
And so
pandemic and the fintech growth.
that's a great
Yeah.
jumping off point. And Conan, I'm curious to pick your brain on this because one of the benefits of living in this smaller digitized world is we now have the benefit of seeing how other geographies are dealing with many of these same issues from a regulatory perspective. So when you think about this issue of how fintech is being regulated, is there kind of a series of global perspectives that you think about that might inform how we think about it here in the US and in North America?
Thanks, Steve. Well, looking around the world, and we're lucky at the IF to have work with financials in 76 different markets, so we have a good view across a lot of markets. And some of the things that Julupa just walked us through are top of mind, I think, consistently and globally, and that is the use and adoption of new technologies like machine learning in different applications, those questions about the third-party risk as you think about cloud service providers that are very different from some traditional vendors. And then we have some other themes that are perhaps a little stronger in different regions. So consumer protection and competition mandate, I think, is particularly strong in Europe. I think on the heels of Wirecard and some digital assets challenges, that's sort of a top of mind in a couple of regions. I think that this question of how do you balance these innovations with the traditional regulatory frameworks that we've got today, how do we modernize the tools for regulation is sort of another theme that's consistent across a lot of markets. And again, Julupa and Aaron both touched on why that's a consistent trend as people step back and think about, okay, what are the shifting roles and responsibilities in these relationships? We talk about an ecosystem approach, and so I think regulators trying to understand how that might work, and then, are they really, do they have the right tools today, and do they have the right talent inside the institution to keep track with how things are evolving and changing in the marketplace? So I think those are the big global themes: consumer protection, competition mandate, and then updating to deal with changing third parties, changing technology tools, that use of cloud, questions about concentration in cloud, and again, changing roles and responsibilities, and how do they supervise and regulate those activities.
So that begs a very pertinent question then, Conan. And Julupa, I'll preface this question, I'm not looking for the Federal Reserve's perspective, just for yours and the other panelists. A question for everybody: what are the gaps or the areas that you think the existing regulatory structure is not adequately addressing in the fintech space today, that if you were the czar of fintech regulation and you could wave your magic wand, you would implement a more higher scrutiny regulatory regime?
Sure, I can go first. So, as I said, a lot of fintech partnership going on, and what we were just talking about was how banks partner with fintech to access technology. But there are also other types of partnership. For example, Cross River Bank may be one of the example. Maybe Aaron can also add later that there are also many banks that are what we call renting the charter. So not just many banks do that. So to originate the loans for fintech, so that they don't need to have license in each state, for example. And also, we see an example of, say, Bancorp Bank that partner with Chime, allowing Chime to actually open 12 million deposit accounts for consumers through this partner bank. And so we see that fintech banks are partnering. There are some non-bank neobank that actually can provide service very similar to actually the real bank, but they don't even have banking license. They don't have physical office, and everything is digital, online. And people have come to expect that everything should be all digital, end to end, and 24/7 service and everything. And so now that we see that there is competition, that is different entities may be subject to different supervision and regulations, not a level playing field. So regulators have been talking about, even before this pandemic it started, but now it actually has grown dramatically during the pandemic, that should we then regulate by activities? Should it be activity based, like all the mortgage lenders, or the same activity should be regulated in the same way. So as they said, if the something walk like a duck and quack like a duck, they should be treated like a duck. It's not that simple. It's easier to say than done. There are also, you know, thought about maybe better to because the banks are complex. It's bank regulations are very complex. You can't just say Googleplex now partnering with 15 banks who offer deposit accounts, checking account. How do we regulate Amazon that provide cloud computing service and Googleplex offering deposit account as a bank? I just don't know how long it would take to do that. And to design it correctly. So I think that's something that we all need to think about, and it will be difficult before it actually can be implemented. Yeah. So maybe Aaron and yes.
Yeah, I'd love to jump in here actually, because I think you touched upon so many important factors, so many different things that we look at in all of these lenses. And so from our perspective, when we look at the regulatory front, I think one of the larger issues we see is a failure to distinguish different types of fintech from each other. So we just talked about the rent-a-charter agreement just a little bit, but there's actually a significant, dramatic difference between what we would call the rent-a-charter and then what Cross River would say is the responsible bank partnership model, right? And so Cross River goes through the responsible bank partnership model, and that really means for us that everything from onboarding to continued oversight, there's really, really heavy regulatory requirements, burdens, diligence, third-party risk management that has to happen internally for the bank and also for the partners looking to come to Cross River. Otherwise, we're not going to onboard them, right? So we do require our partners to have the appropriate licenses in every state. Just because we're the bank that they're partnering with, it doesn't absolve them of any potential regulatory responsibilities that they may have. There's significant oversight into when it comes to the lending, especially the credit policies that are happening. The institutions partnering with us understand that they have to follow all of the laws and regulations, that are applicable, that Cross River has to follow in the space to ensure consumer protection. Use-free rate is obviously a rather large issue, and ensuring that we're offering affordable access to responsible credit, that our products are actually helping consumers break cycles of debt, not creating predatory debt traps at exorbitant interest rates. And so when you look at the rent-a-bank agreement, it's really exactly in the name, right? There's institutions out there. We're not going to pretend like there's no bad players within the space. Institutions out there simply using their charters to kind of pump and dump loans, hiding behind, letting fintechs or third-party companies in general hide behind their banking charter, and then saying, it's now that responsibility is on the third party. We're the bank, we're absolved. Cross River does the exact opposite. We own the end-to-end life cycle of that process and understand the importance of that regulatory compliance and oversight. And so when we look at this space, that's a really important distinguishment to make. And it trickles through the industry when you look at fintech and the operators in the space, right? It's not just lending. It's not just the bank partnership model. I think it's important to make those distinguishments as we move forward so that we're fostering responsible innovation. We're allowing creativity, solutions. We're evolving as an industry. We're allowing companies to be nimble. But at the same time, we're ensuring that the consumer protection protocols and safeguards, safety and soundness principles, the integrity of the financial system, they're all intact. And you don't have to sacrifice one without the other. And Cross River has kind of been an example of that from the very beginning.
So I think you made a good point that yes, fintech is a very broad term, and when we look at fintech, even just lending, that's why we actually during this pandemic we see two tracks, right? Like some fintech, actually, if you look at market evaluation as an indicator, you can see that some actually tank and some actually boom, and also you made a good point that in terms of due diligence, because there are several fintech firms that I talked to that said that actually, and they actually have applied to become a bank themselves, right? And that's because they said that they would have to go through all these compliance process anyway when they partner with a bank. If they're doing all that, why don't they just apply to be a bank themselves? So you can see that Lending Club has become a bank holding company. SoFi has been approved to have a bank charter, and Square is now has a bank. So you can see that there are different types of fintechs, and I can't just generalize it. Yes.
Right.
So
And to
I should
even
have
just go
mentioned that.
one step forward quickly, I would say that the transparent and responsible actors in the space want extended oversight. They want extended clarity from the regulators. They want to know what licenses are applicable, because knowing all of that information allows everyone to go ahead clearly, to create, to innovate, to partner, understanding what the rules of the road are. And so smart regulation that helps kind of create a non-ambiguous, non-fractured structure is exactly what institutions want in the space, so that they don't have to worry about running afoul of regulatory rules and requirements, so that they're ensuring that they can offer the best product and they're doing it in a responsible way. And so that's what clarity in the regulatory space helps provide everyone.
And Conan,
And
I'd love to pull
I
you
think
in here, and I also want to put a bug in your ear on activities versus entities based. So hopefully you can hit on that too.
Yeah, exactly. That was the point I was going to make, was that as you listen to what Julapa and Aaron were talking about, I think that it's that stress that, activities-based regulation, sort of same activity, same risk, same regulation, seemed like a settled way forward a year ago. And I think there's been a lot of question of that today for all of the reasons that Julapa and Aaron have just laid out. And that is, not all entities are the same. You have very different scales. You have, as Julapa had observed, big tech moving in a way that's very different from some of the other non-traditional actors. So you can't just say new entrants or different business models and look at things just as an activities-based lens. And I think we've seen a big shift globally in regulatory signal on that over the last several months. You had the Basel global standard setting bodies of the Bank for International Settlements head, Augusta Carstens, and Fernando Restoy, who's the chair of the Financial Stability Board, both come out in January and say activities-based might not really work in some of these instances, and we need to think about the entity. After all, it's the entity that we supervise. So I think for fintechs looking at this scene, there is now a recognition that not everything is the same, a recognition that there needs to be perhaps a more tailored, focused approach, and a lot of focus on the role of big tech. So I think that some of the issues with fintech and big tech being lumped together, I think you'll see a shift away from that moving forward, and that should help as there's a parallel effort to try and modernize the regulatory framework to deal with some of the new business models that have emerged. I think within the U.S., you also, sorry, go ahead, Steve.
No, I was gonna say, Conan. So I want to ask a controversial question to you, if you don't mind. So I was having a conversation with a fintech founder last night, because that's what I do in my free time, and he referred to the positioning of incumbent financial institutions, not Crossroad Aaron, the big guys who are kind of more anti new entrants, of big tech as the big tech boogeyman, right? That this is fear mongering around big tech coming in and owning the space. And that's a blocker that some of the larger institutions are using to keep their interests entrenched. So, Conan, how real, in your view, is the fear of big tech moving in under existing regulatory frameworks? And to what degree is it commercial interest versus real gaps in the regulatory apparatus that need to be addressed?
Well, I think that with big tech and finance, you do have sort of an unprecedented development. You have, and there are lots of dimensions to their entry, and there are lots of components to these hyperscaled operations. So they have cloud service provider divisions that are key for moving forward and transforming the industry. And I think the digital transformation of banking will be very difficult without use of the cloud services that these three entities offer. They also are major platforms for discovery, shopping, engagement, and as we think about embedded finance and embedded payments as part of an e-commerce experience, and then also put together the power of data and insight and the advantages that they have in the scale of data. I think that when you start to put some of these components together, it's not necessarily fear-mongering, but a recognition that these are very different entities than we've had before, and that they change the market, change the business model, and change some of the roles and responsibilities in a way that we haven't thought through for a long time. So I don't think that there's a great likelihood that Google Bank launches and becomes sort of a single mega entity. But I do think that the different components of these hyperscale technology firms and how they work with financial services. So if you have front-end customer engagements, all happens through that channel. If all of the back-end balance sheet compliance, AI, machine learning applications are on the back end, and you really just have regulated product manufacturer in the middle by a legacy financial sector, then I do think it's a significant shift, and I think it's a development that regulators are looking at and weighing carefully. But again, there's definitely been a recognition over the past couple of years that these entities are very different from a fintech partner who would come in and try to provide an analogous good or service. So hopefully it's not fear-mongering. Hopefully it's just looking at key partners for financials. And again, that's the complicated issue, is that when we think about digital transformation of the industry, these cloud service providers are essential partners for the legacy industry to try and keep pace with the digital economy. So complicated mix.
Yeah, no doubt.
Now,
Aaron, Jalapa, do you guys agree with that assessment? Oh, Jalapa, please.
Yeah, I have something to add that now, yes, we may be thinking of big tech entering banking service by creating a bank like Square is doing that. But we now actually, there's an option that they could also do it through partnership, right? That what we see now, Google is partnering the Googleplex program, partnering with 15 banks, but now they're experimenting Citi, which is one of the largest incumbent bank. So if Google and Citi are partnering, and Goldman Sachs is partnering with Apple, so I think it is becoming blur, right? So banks are becoming tech, and techs are becoming banks, because the tech firms have collected so much data, right? They have like a huge amount of data about everyone. And it used to be that banks had cash flow data, and that was like more data than anyone else in credit to use for credit decision. It's not anymore. It's a tech firm that has a lot of data, and through partnership, who knows, it could help these 2 billion people who have no access to financial services now, who are left behind, could be starting to get access with alternative data and more information that big tech has collected, and partnering with incumbent institutions.
I think those are all really great points. And so I'm happy we were able to distinguish here also between big tech and fintech, because I think there's a huge difference in what those two different services offer, and the direction of those two, the evolution in the industry. And so what I would like to add, and I hope I don't sound like a broken record here, but it's really about responsible innovation, right? And so as we think again about this next evolution, almost prematurely, right? It's starting to happen. You see the entrance. Fintech has already now found its kind of footing, and still figuring out some of that footing going forward, and becoming more and more embedded into what banks do and how we operate. And now you're going to have a kind of a big tech evolution come in there as well to talk about what's going on and offering new products, but it's really about protecting the integrity of the financial system. Are the products that are being offered consistent with the principles of safety and soundness, right? Are we going to have to worry about any forms of risk? What are, obviously, as new opportunities comes, new risks come about as well. So what are those? What do those look like? How do we navigate and manage them so that we avoid any potential harm or crisis or any negative effects? And how do we be proactive about that? But especially if you're a bank like Cross River, right? We're a small community bank based in New Jersey. We have one branch, but we've consistently punched above kind of our weight class, and that is because of our ability to innovate. It's our ability to be nimble, and really all credit goes to our management, our senior leadership, who have really kind of constantly seen ahead of the curve. But one thing that is clear about all of these evolutions and these new entrants is that if you are, whether a legacy institution like we're talking about, or a community bank, whatever you consider yourself in the space, a more traditional financial institution, if you're not able to innovate, to move forward, and to embrace this new technology, to find solutions for your customers, it's going to be very difficult to survive in the future. I think we've all kind of touched upon that we live in a very digital world. We do things very differently than traditional banking has been done in the past. And so if you don't have the core infrastructure and the culture at your institution to provide that nimbleness and bring on these new partners in a responsible way, it's going to be very hard for you to grow and move into this new age of financial services.
And I think that's an essential point, that the innovation and transformation of the industry needs to keep pace. There's a lot of work to do on inclusion. And I think that that's the challenge that regulators see as you try to harness these new technologies, the creativity and innovation of business models, but prevent some of the risks that you've seen perhaps in, for instance, the Chinese market made a huge progress on financial inclusion, but one of the costs that came with that was the incredible concentration and market power of just two digital platforms. And the regulators there have spent a lot of time and effort over the last decade to try and harmonize that back in with the legacy financial services industry. So I think that challenge of how do we harness the efficiencies of scale and the ecosystem model and allow for new entrants and innovation while trying to deal with the unprecedented concentration and concentration risk and scale that some of the hyper players present.
Right. I think there's competition and financial stability have been two main concerns among regulators. But also I wanted to elaborate a little bit more on that, how important data has been, right? As I said, now actually we have seen some mantras. People are saying that data is now the new currency. It's very important, and so by partnership between tech and banks actually could potentially benefit everybody. For example, if you look at Square, right? I'm not talking for Square, but as an example, that because of its proprietary data about these people who actually don't have credit access through incumbent banks and very small businesses, but they could observe all the transactions and activities through the payment platform. It's same for PayPal and Amazon. And so they are able to actually grant these credit lines and business loans to these consumers, to business owners. And so credit access can be expanded without increasing any risk to the lenders. I think that's ideal. So that's what we want, right? But at the same time, there's a risk is an important consideration: cloud and financial stability and competition and concentration. But if we could achieve credit expansion without increasing risk, and so regulators would try to balance between regulations and also try to also encourage innovation and data collection, as long as data is used appropriately and don't violate consumer privacy.
And that's another important trend that. sorry, that we've seen globally is that question of the flow of data and ensuring the free flow of data across sectors, but also across markets. And we've seen a number of leading voices. Ravi Menon, who leads the Monetary Authority in Singapore, at our meeting in September, said there really isn't a digital rule book for the digital economy the way we created with the Bretton Woods system for the trades in goods and services across border, and that's really something that needs to exist, is the rules for data to flow in a secure way across sectors, so that it's not just locked up in certain silos or certain entities. And we see markets around the world consistently trying to work on that, both within their borders for the flow across sectors, while balancing privacy concerns. So I think that question of data governance and data ethics is a key theme that we see, and we've been doing a lot of work on at the IF.
And I'd like to then, we've got maybe about 5 or so minutes left. So I want to end on a kind of forward-looking question. And Aaron, I'm going to pick on you, because it strikes me that when you're talking about Cross River's position as a responsible innovator, really what that means in the context of this conversation is Cross River has exerted significant governance over its partners over the last many years that maybe others have not, which effectively puts Cross River in the position of a de facto non-regulator. So let's wave our magic wand. Let's transport ourselves maybe 2 years into the future. We're having this conversation in person somewhere, safe, all vaccinated.
Hopefully. Yeah. Hopefully
what are you? Yeah. Well, 2 years I think is quick in regulatory land, so that's why I picked 2 years. What would you hope has changed from a regulatory perspective between this conversation today and the one that we would have 2 years from now?
Yeah, I mean, I think I really touched on the importance of distinguishing these different partnerships and agreements. And we've talked a lot about partnerships, but one we haven't talked about, which is probably one of the most important, which is, how we get from where we are today to the 2-year mark you're talking about, is partnerships between the industry and the regulators. And I don't mean partnerships like Cross River is onboarding a third party. I mean partnerships as in the industry is responsible to go and work with the regulators, to have conversations exactly like we're having today, to make sure that your regulators know who you are, understand the direction of where you're heading. Most of the offices have, especially the innovation offices, have office hours that are open to regulated entities. And so it's really on industry to be transparent, be proactive, and be engaged with their regulators. And that is really one of the biggest ways we're going to drive progress in the right direction and have smart regulation, right? Not regulation for the sake of it, but regulation that makes a tangible difference, creates important safeguards, rails to ensure that everyone is abiding by the rules of the road, and that consumer protection is of the utmost importance. But there is also something really important that I think everyone slightly touched on that I think we'd be upset if we didn't expand on a little further, and that's the importance of financial inclusion here. And I think that's the ability of fintech and these partnerships as we continue to look at recovery, at bringing people into the financial fold, at creating a more equitable financial system and shrinking the racial wealth gap. The power that fintech has to play, and technology generally has to play a role in this. We just talked about a little bit about credit underwriting and the evolutions there, and how we're able to extend credit with minimal or less risk, right, to people who would traditionally not qualify for products and credit products, and be steered towards some sort of exorbitant interest rate product that traps them in cycles of debt, hurts their financial health. And so that's going to be a huge part of the next chapter, I think, right? How do we continue to bring more people in the fold, and how do we create a more resilient and inclusive financial system?
Same question to Conan and Jalapa to
I
finish us out.
Yeah, I agree that, I also see that in the next near future, there will be less distinction between fintech and incumbent. institutions, because banks are acquiring technologies, and many of the tech firms are also providing financial services and banking services. Over the years, it will become blur who is doing what. And I think the partnership that Aaron talked about, yes, it's at the top of our mind as regulators. Besides office hours that the Fed and OCC have been doing, we also this is just for everyone to attend as well. To invite you are all invited to attend our FinTech Partnership Symposium at the Philadelphia Fed, coming in 2 weeks. And so our goal is to make things easier for banks and FinTech to partner to try to create this and support this ecosystem that support FinTech partnership, and that would allow a lot of it's much easier for larger banks to acquire technology, but we have at least 5,000 small banks in the US, unlike any other countries, not like in Europe. And so we are trying to also make it possible for small banks to access technology through a FinTech partnership. And that's what the conference is about. And it's going to be a series. This is the first one that we are doing at the Philadelphia Fed.
And thanks, Steve. I think that in 2 years, hopefully we look back and see that all of this engagement and work, like the conference and the office hours and the outreach that Jalapa just outlined, has really borne fruit. And I think that updating and modernizing frameworks to deal with the new technologies, cloud, the ecosystem model, to allow for much more innovation and creativity, no matter what the entity is that's moved forward, but to deal with those entities sort of appropriately, so that data and privacy and cloud and digital identity and all of these powerful new tools can be really deployed for those outcomes that we've talked about a little bit, which is better financial inclusion, making sure that the SME sector can plug in and grow as well as any other. And hopefully that's where we'll be in 2 years, looking back at all of the great fruit from this regulatory engagement and modernization.
And I think after that 2 years conversation, we should all get together for a drink or dinner in person and talk about it. So let me thank you all very much, Conan, Aaron, and Jalapa, for your insights, for your time, for your expertise. This was a fantastic conversation. Greatly appreciate it. I hope that everybody will stay with us on the industry stage for more great content, and looking forward to keeping in touch over the next months and years to go. Thanks, everybody.
Awesome. Thank you so much, everyone.
Bye.